Welcome to This Explainer. Today, we're uncovering something absolutely massive: how banks secretly make billions of dollars. We're going to dive right into this towering, kind of opaque financial system, use some amazing visual data to see exactly how Wall Street operates, and most importantly, figure out how you can protect your own wealth.
So let's kick things off with a really provocative question. Is the money in your bank actually yours? Think about it. When you deposit cash, it doesn't just sit in a vault with your name on it gathering dust. The second it leaves your hands, it's immediately deployed by Goliath-sized institutions to generate massive profits. We tend to think of a bank as a storage unit, right? But it's actually an incredibly active, non-stop factory. Just to put that into perspective, the average consumer loses hundreds of dollars every single year to hidden fees and lost interest alone, all while the banks are netting billions in profit quarter after quarter.
All right, let's get right into it. Section 1. The Wealth Machine Uncovered.
Peeling back the very first layer of the financial onion, we find a gap: 5%. Now, 5% might not sound like a whole lot at first, but it represents the typical difference between the 1% a bank might pay you to hold your savings and the 6% they charge to lend your exact same money out to somebody else buying a house or starting a business. It's a simple concept, sure, but when you multiply that 5% spread across literally trillions of dollars in global deposits, the sheer scale of that wealth transfer is just staggering. And that brings us to the net interest margin. This is literally the hidden engine quietly making banks billions of dollars off your idle cash. They are essentially renting your money for cheap, leasing it out at a premium, and pocketing that massive difference. It's this brilliant insider secret hidden right in plain sight, and it forms the very heartbeat of the entire traditional banking sector.
Moving on to Section 2, Anatomy of the Market. To really understand how this machine works and how it scales up to the entire global economy, we've got to look at the underlying blueprint of every financial entity out there, the balance sheet. And the golden equation brilliantly illustrates the foundation of all finance. It basically says that everything a business owns has to be funded by either borrowing money or by the owner's invested capital. This is the absolute bedrock of how money moves anywhere in the world.
Whether we're talking about your personal monthly budget or a massive Wall Street corporation, grasping these three pillars is your absolute first step to taking back control. Assets are what you own, liabilities are what you owe, and equity, well, that's what is truly yours. The goal of the entire financial game is to constantly increase your assets and your equity, while ruthlessly and carefully managing your liabilities.
Which leads us to Section 3, the Titans of Trading. Now that we know how the foundation is built, let's zoom out a bit to the massive funds moving trillions across the global stock market. You've got a stark contrast here. On one side, we have accessible, low-fee index funds that passively track the market for literally pennies on the dollar, but on the exact opposite side, we have the exclusive, high-risk world of hedge funds. These guys actively make aggressive, heavily leveraged bets to try and beat the market averages.
And speaking of those hedge funds, they chase massive returns using really dangerous leverage, eating up a huge portion of any gains in fees. Actually, a lot of hedge funds historically underperform the basic stock market over a 10-year period, yet their managers still walk away incredibly wealthy. Why? Because of the famous 2 and 20 model. It's a guaranteed 2% management fee regardless of performance, ensuring the house always wins. But wait, it gets wilder. A new breed of titan has emerged: the quant funds. These guys rely on ruthless algorithms and raw data to find market advantages, what they call alpha, at lightning speeds that are just far beyond human capacity. I mean, they're scraping data from open-source code repositories, e-commerce platforms, you name it, hunting for the absolute tiniest signals to execute trades in a fraction of a second. Today, algorithms like this are responsible for a massive majority of all daily trading volume.
Section 4. When the system breaks.
Because what actually happens when these towering three-dimensional structures of debt, leverage, and algorithmic complexity begin to crack under their own weight? Well, systemic collapse is not random. It is a repeating historical pattern where the system's promises just outgrow its actual cash flow. We've seen it play out in Thailand in '97, Argentina in 2001, the US in 2008, Cyprus, Greece. The core issue is always exactly the same. Immense pressure builds up on fragile financial foundations, leading to totally devastating bank runs. And here's the truly terrifying truth. The final stage before a collapse isn't the crash itself. It's this period of managed illusion. Right before the crash, ordinary savers are often lured into a false sense of security, while the highly connected insiders quietly escape. Officials offer calm words and delay recognizing real losses right up until the exact moment the bank doors unexpectedly lock and the ATMs are shut off.
All right, Section 5, your financial defense blueprint.
So knowing the game is kinda rigged and the system is fragile, how do you build an absolutely impenetrable defense for your own wealth? You need a strategy that protects you regardless of what the broader market is doing. Enter the 50-30-20 budget breakdown. This is your personal armor. 50% of your income for fundamentals, 30% for fun, and a vital 20% fiercely protected for your future self. Visualizing your money like this forces you to prioritize building real equity instead of just blindly funding a lifestyle.
And here are the exact steps to build that fortress. Following these structured steps ensures you have the liquidity to survive financial shocks without falling back on high-interest credit cards. First, save exactly 1 month of living expenses as a quick buffer. Next, ruthlessly destroy high-interest debt. Anything over 8% is an absolute wealth killer. Get rid of it. Finally, build a full 3 to 6 month emergency fund, so you have cash to keep you safe during literally any economic storm.
Now, when it comes to destroying that debt, you literally have to choose your weapon. You can go with the mathematical efficiency of the avalanche method, which attacks the highest interest rates first to save you the most money. Or you can use the emotional momentum of the snowball method, knocking out the smallest debts quickly for those big psychological wins. Honestly, just pick the one you know you will actually stick to, because consistency is the only real way out.
Section 6, the ultimate retail strategy.
Once your defense is locked in and your debts are managed, it's time to play offense and grow your wealth. First things first, stop bleeding wealth on depreciating assets. Remember, a car is an expense, it is not an investment. Following the 24-10 rule, a minimum 20% down payment, a strict 4-year loan term, and keeping total vehicle expenses under 10% of your monthly income ensures your money isn't totally consumed by a liability just sitting in your driveway.
Next up, get your money into the market. Why? Because historical data shows us that over a 20-year holding period, the S&P 500 has consistently delivered positive wealth-building returns. Look, any single year can be super volatile, but stretching your timeline out historically guarantees growth. The historical median return sits right around 8%, and that is exactly the engine you need to actually outpace inflation and build real generational wealth.
And by utilizing low-cost exchange-traded funds, or ETFs, you are effectively bypassing the expensive Wall Street Goliath and becoming the boss of your own compounding wealth machine. You get instant, broad diversification across hundreds of top companies and steady growth, all without paying those absolutely crazy 2 and 20 fees to an active hedge fund manager.
Which brings me to the absolute most critical takeaway from today's explainer. Time in the market is the one single advantage you have that algorithms and hedge funds literally cannot buy. The compounding effect of money over decades is a mathematical certainty, but it relies 100% on you starting early. Every single year you delay is a year you lose freedom.
So, I'll leave you with this final thought. The blueprint is right here in your hands, but that first step is entirely up to you. Are you going to let the financial system keep profiting off your hesitation? Or will you take control of your wealth today? Wall Street has built systems perfectly designed to benefit from your inaction. It's time to turn the tables, build your own foundation, and start securing your future.